Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing Forex options, assessing options. Probabilities. If you've been following our options video series, you've understood that option trading is a game of chance. Thus, if you hope to succeed at trading options, you must strive to consistently place the odds in your favor as much as you can on every trade you intend to make. Options have a time premium with a set expiration, and that makes their probability of profit to be less than 50%. Pros and cons. Although Forex traders are used to having an opinion on whether a pair is going to move up or down, the options trader should not theorize about it, but comparing the risk to the reward characteristics of several possible trades to decide which is the most desirable. Dreaming about unlimited profits while buying low probability options or selling far out of the money options with high probability of profits without maximizing the risk is a recipe for disaster. The delta as a proxy for probability. An option's delta can be determined for each option using an option pricing model, which usually is made available by the broker to its customers. Sites such as investing.com display the delta of the most usual FX options. Delta values range from 0 to 100 on calls and from -100 to 0 on puts. Delta can be viewed as 1. An estimate of the odds that the option will be in the money at its expiry. For instance, if the Euro-USD at 1.1650 September call has a delta of 0.33, it has about a 33% probability of expiring in the money. 2. A delta of 0.33 implies that the option moves 0.33 pips for every pip movement of the underlying. A delta of 100 means the option position is equivalent to buying the underlying asset. Thus, a delta of -50 is equal to being short of the underlying with half of the original position size. Please note that the delta of an option changes with time and price movements. Delta neutral. Delta neutral is the way to place the overall trade position so that the delta nears to 0. This can be achieved by halving a combination of options with the positive and negative deltas so that their summation is near 0. Delta neutral traders do not bother with the market movements because they do not affect them. Their task is to keep their position neutral, rebalancing it when their position moves away from the neutral by opening new positions and/or closing open ones. According to the advocates of this methodology, delta neutral strategies naturally make a trader buy low and sell high, creating a consistently profitable game. Probability and risk analysis. Options traders usually have several ways to fill an option trade for determined strategies. Thus, evaluating the probability of the risk of the position trade combinations will determine the most profitable and best candidate. For example, a trader may decide to buy a put and a call on the Euro-USD pair before a potential disrupting event. That way he will profit from the volatility raise without caring about the direction, but he may be in doubt about whether to buy them at the same strike price, known as a straddle, or a different price, known as a strangle. The trader must consider the following for every candidate combination. 1. The upside and downside break-even points. 2. Probability of being outside of a BE at expiration. 3. Profit expiration for the upward and downward targets. 4. The maximum loss of the option combination. And 5. The likelihood of expiring the maximum loss. A table made with these parameters will show the best alternative, which in this case is a straddle, as it shows the best setting and also the highest rewards for its risk. To summarize, we're going to show that the keys to succeeding in options trading are as follows. Identify the strategies available, understanding when to use a given plan to maximize the benefit, accurately evaluating the level of the current volatility, identifying whether it's time to buy a premium or sell. Premium. Buying undervalued options and selling overvalued options. Recognizing when there are disparities in the implied volatilities of different options and taking advantage of the fact. Properly take your profits and cut your losses. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.